Good day everyone, I'm Tony Tam Jie Lun, your trusted financial advisor. Last time, I was at the Singapore Stock Exchange, reflecting about the lessons I learned after attending the Singapore Exchange annual general meeting, and reflecting on the lessons and combining it with my investment experience so far. This time, I traveled to the Shanghai Exchange for a business trip and decided to continue this series 3,800 kilometers away from the little red dot. I would like to share about my past experience in the Chinese equity markets, from my past experience at the sell side in the investment bank, and my personal experience as an investor in China market. Unique quirks about China market. Number 1, unique regulatory structure. If we invest in China, we cannot apply the same Western framework. This is a centrally planned economy operating with markets. Our foundation in Singapore is based on the Commonwealth law, or in China, it is a civil law system. What does it mean for investors? It means that the government is inherently stronger than the merchants and the public investors. In China, the government effectively sits on the board of every listed company through various entities. Here, government policies, the macro level directives, dictate market direction far more than pure free market forces. This brings us to point number 2, the importance of diversification. Companies with traditional competitive advantages with barriers of entry can be immediately disrupted if the business model runs afoul of the government's initiatives, as the government policies supersedes the economic welfare of the business and the merchant. This also means that most industries and companies can be disrupted when the government configures its 5-year plan and pours in huge subsidies and regulatory changes to support its new government initiatives. The recent clampdown on the edutech sector, and also the concerns about the spiritual opium of excessive gaming, these are not attempts to just crush businesses. These are actually regulations and social reform. This is a crucial lesson. Policy rules can be severe and sudden and motivated by social initiatives and not just economics. And diversification and position signage is very important when investing in Chinese companies. Number 3, restricted currency and restricted information flow. People who have business exposed to China or dealt with the Chinese equities will have known about the Great Firewall of China. Information flowable to China can flow out of China easily, but information flowing into China is heavily regulated and reviewed. For the currency, it is opposite. China uses a CNH-CNY system, whereby globally, CNH is traded in global markets. The local Chinese within China uses the local CNY renminbi, which is very difficult to repatriate out of China. This has important considerations for investors. If they wish to grow their wealth, but also safely utilize it, it is important to diversify their assets beyond the home country to overseas markets, so that they can both grow their wealth and preserve their wealth safely. If they need help, they should speak with a trusted financial advisor on how to navigate this safely. Investing in China can be summarized with 2 words, 危机. You are partnering with a sleeping dragon, which has great risk but also great opportunity. The investment journey here requires vigilance. It is exciting, but it demands that we respect the unique structure. Choose your allocation wisely, respect the social goals of the regulatory environment, and choose your investment partners wisely with the highest scrutiny. That's how you let compounding grow your wealth, even within the complexity of the Chinese market. Want to know more about investing in China or building a diversified investment portfolio beyond a single country's border? Go with your trusted financial advisor now.